Welcome to Kitco's Coffee Break webinar series. We're happy that you're joining us today for Jim Wyckoff's webinar on technical analysis. Jim will give you an overview of technical chart terminology, the basic of charting, and using charts to identify existing price trends or other patterns in order to better determine a market's near-term direction. Jim's objective is to help you to make smart decisions. And while we're speaking of smart decisions, I'd like to mention one Kitco product that can represent a really smart choice: Kitco pool accounts. Kitco pool accounts are a very cost-effective means of buying, owning, and selling gold, silver, platinum, palladium, and rhodium. With a pool account, you can cut out the brokers, pay no commissions, shipping, storage, or insurance charges, and buy or sell online or over the phone. You thus get into the precious metals market in the most economical and convenient way possible. Just visit online.kitco.com to learn more about Kitco pool accounts. And now it's over to Jim Wyckoff. Enjoy the webinar.
Well, good afternoon, everyone. I am so glad everyone could attend this educational webinar, the first of its kind. Just the fact that you all have signed up to attend this webinar is a good thing. I've been in this business almost 30 years, and I learn something every day. And it's my mission in this webinar to have you take away at least one valuable nugget or one valuable lesson that you can apply to your own investing or trading methodologies that's going to make you a more successful trader and investor. So the primary topics of today's webinar are going to be what I call my primary trading or investing tools, which is basic chart analysis and especially the trend line. I'm going to talk a little bit about the very important aspect of trading psychology in the marketplace. And then I'll finish up with an in-depth explanation of my Wyckoff's market rating system. And if we have a little bit of time at the end, I can also answer a few questions too. I was fortunate when I got into this business to be able to work right on the trading floors in Chicago, New York, and around the world and talk to traders and analysts as a reporter and glean from them some of their traits and characteristics and methods that made them successful at what they did. I was also fortunate as a reporter to be able to attend seminars back then. Back then they didn't have webinars. You attended a seminar and workshops, and I was able to touch base and chat with some of the world's best traders and investors. And it allowed me to compile a list of characteristics of a successful trader and investor. And one more thing, when I first got into this business, the computer age was in its infancy as far as trading software and analysis software. So I had to plot my charts by hand. I had to, I read a lot of books. And these books I read were written by traders back in the early 1900s, the mid-1900s, and they too espouse some of these things I have written down here that define a successful trader and investor, and I'll just go through them real quickly. You need to have emotional control, a good family life. In fact, a good family life was espoused by Richard D. Wyckoff and Jesse Livermore, two famous traders back in the early 1900s. You need to have the ability to focus, a sense of humor, able to closely follow a plan, seeks to improve and learn, and obviously the fact that you all are attending this webinar, that's a good thing. You're seeking to improve and learn. You can't have a big ego if you want to be a successful trader or investor. You need to have some self-confidence, of course, willing to work hard. One thing I always tell people that are new to this business is that you don't become a successful doctor or lawyer or any kind of professional in a few days or a few weeks or a few months. It takes a lot of hard work. It takes study, and hard work will eventually bring you success. And finally, and this is especially true for a shorter-term trader or investor, you need to have the ability to take a trading loss without it having it ruining your psyche. One of the things that I learned very early on in my process of reporting and analysis and reading books was that, as my friend Stuart Taylor said in a webinar many years ago, simple is simply better. Simple and obvious is better than complex and convoluted. By that I mean, especially with technical analysis, sometimes a trader can have so many things he's looking at and there could be conflicting signals. And the best thing to do is to break something down into its simplest terms, and by that we will look at price trend. Before we get to price trend, one other thing I learned early on, and you probably have all known by now too, is there is no holy grail in trading and investing. There is no surefire 100% system that's going to generate 100% trading profits for you with no losses. It's just not the case. If it's too good to be true, then it probably is too good to be true. My primary trading tools, as opposed to my secondary trading tools that we'll probably talk about in another webinar, my primary trading tools are basic chart patterns and things that I can decipher just by looking at a chart. As I said, when I got into this industry, I had to plot my charts by hand and plot my prices by hand, and the books I read by W.D. Gann and Livermore and Charles Dow all used the basic chart or graph for their analysis, and so I have applied those same methods, even though the computer age is evident nowadays. We'll talk about trend lines. We'll also talk a little bit about fundamental analysis when we get to the psychological part of this presentation, the psychological trading techniques. There's a lot of old adages in this business, and one of the most tried and true is the trend is your friend. Most successful traders, in fact, virtually all successful traders and investors have some kind of trend acknowledging or trend finding or trend following methodology in their trading strategies. And we're going to define price trend here. A trend is simply a price uptrend is a series of higher highs and higher lows on a chart. Now, these charts we're looking at are bar charts, and every line you see on those charts represents a high, a low, and a close, which is a little dash on the chart. These charts may be a little too compressed for you to see it, but later on you'll be able to see the little check mark to the right of them. That's the close. But the bar defines the day's high and the day's low, or the period. These bar charts can be used on a daily time basis, or a monthly, or even an hourly. So most traders do use bar charts in their technical analysis. But a price uptrend is a series of higher highs and higher lows, as we see here on the chart. Conversely, a price downtrend is a series of lower highs and lower lows, as we see here. Now, you might think that a market can only trade in two directions. It can either trade up or trade down, but that's not really the case. A market can also chop in a sideways fashion, like we see here with the yellow shaded area. In fact, most of the time, most markets do trade in a choppy and sideways fashion, and that's why trading is not an easy endeavor. The successful traders and investors try to seek out trending price moves or just trending moves that are starting to develop, and then employ their trading strategies. But the markets that are in sideways and choppy ranges, a trader or investor can get long the gold market one day and then see the market see a downside correction and be chopped around. That's the frustrating part of trading in a choppy market. Here's another price uptrend. And I want to point out here that there is no exact science in pinpointing a price trend. The reaction highs and reaction lows that we'll discuss here in a second, there's no exact method for trying to pinpoint those. Looking at a chart and determining a price trend is a lot of art involved in that and a lot of experience. But that's what you're here for, is to gain some knowledge and experience in trying to determine price trend. Okay, we're going to talk about reaction highs and reaction lows in a trending market, and this is important in determining the price trend. Here on this chart, and you'll see that I use a lot of different charts. The great thing about the technical analysis that I use is you can apply it to any market. You can apply it to the futures market. You can apply it to the stock market. It all works in all markets. So I do have some different examples, different markets here that are good for visual examples. But these methods do apply to all markets. So here we see a price downtrend in place, and you've seen that I've drawn a downtrend line off of some reaction highs in a downtrend. And you'll see that the market is trending lower, but occasionally it will see an upside corrective bounce, and that's called a reaction high in a downtrend. And the market then goes on to trend lower, pops up again, posts another reaction high only to continue to trend lower. Here's another example of some reaction highs in a downtrend. Now, when the market price pushes above, for example, the last reaction high you see here in this downtrend on the T-bond chart, if prices would happen to push above that last reaction high in the downtrend, then that downtrend would at least temporarily be negated. And then you may see choppy and sideways price action, or you may see an uptrend develop. Here we see a price uptrend, and then we see some reaction lows in an uptrend. Market's trending higher, see some profit taking or corrective pullback, only to trend higher, and then trend lines can be drawn off these reaction lows. Now, a very important part of technical analysis and market entry is trying to determine support and resistance levels on the charts. That is a very basic part of technical analysis, is determining support and resistance levels. As we see here on this chart, we have a price downtrend, a choppy price downtrend that's in place. And note that the pink support line that I've drawn horizontally across this market, you'll see that several lows dating back several months on this chart were hit, and then the market bounced back up. So that is a very strong technical support level. And when you draw horizontal lines across charts and you find that highs and lows are aggregated very close to a certain price point, then that's probably a very good support or resistance level. And once again, just like in determining price trend, there's no exact method by which a trader can determine support and resistance. And at the end of this segment on support and resistance, I'll give you a visual guideline. But a lot of traders like to use, for example, in gold, there's the 200-day moving average that people use for support and resistance. You can use previous highs and lows and other methods to determine support and resistance on a chart. Here we see a market that has pushed above a trend line, a downtrend line, and then we've got a fledgling uptrend that started. And when a market pushes above a downtrend line like this, that's a bullish clue. Here we have some more support and resistance and trend lines drawn. Also see that prices are in an uptrend on this chart. And there's two trend lines drawn. A lot of times, and the more times when you draw a trend line on a chart, the more times that prices touch that trend line, the more powerful that trend line becomes. Here's another chart. Price uptrend in place and support and resistance lines. Now you can look at, when you look at a chart, you can look at the market that you're following, and you can look and see, for example, last week's highs or last month's highs or last year's highs, and those are probably going to be solid technical resistance levels in the market. Same way with last week's low, last month's low, or a yearly low. And you can look at a chart, for example, this chart right here, you can look at that chart and you can see significant highs and lows, and those are going to be technical support and resistance levels that you'll want to watch. Okay, so support and resistance levels, to repeat, are determined by significant highs, lows, major yearly, monthly, weekly, or daily on a chart. One thing I didn't mention was the round or psychological numbers. For example, $1,000 in gold, $1,500 in gold, $2,000 in gold. Those are very key psychological price levels. For example, with today's price in gold, there's psychological support at the $1,600 level. There's psychological resistance at the $1,700 level. Those are just round numbers by which trading orders tend to aggregate and are touched off if those prices are breached. Support and resistance can be determined by those trend lines that I draw. It's called trend line support or trend line resistance. The number of times a price bar touches a high or a low level when you draw those horizontal lines. And again, the more times the price touches that bar, the stronger that support or resistance level is. And I also have gaps on price charts. With the advent of electronic trading, we don't see many price gaps anymore. But in the olden days, when you just had trading that occurred in a market and then the pit closed and it didn't open until the next day, a lot of times you'd see price gaps on the charts. You don't see that very often, but they do occur occasionally. And when that does happen, those levels are support or resistance levels. Also, retracement levels, specifically Fibonacci. And don't have time to get into the Fibonacci methods here, but those types of things can also be support and resistance levels. And then finally, moving averages or other chart patterns can provide support and resistance levels. So if you're a trader, especially a more active trader, you're going to want to look for these support and resistance levels. And if your market penetrates a support level, say on the downside, that's probably going to produce a little bit of chart damage at least, and then maybe accelerate the downside price move. Whereas if a market pushes above a resistance level, that's going to give the bulls some encouragement and some momentum and probably augur for a push higher in prices. Okay, well, we're going to spend the next segment talking about trader psychology. And it's very important to acknowledge that psychology is a very important factor in the marketplace and trading and investing. And you can think of it this way: a market's price is nothing more than what a group of humans perceives a fair price to be. So if you believe that human nature repeats itself, which most of us I think do, then it's logical that human behavior repeats itself. That therefore price history and chart history is going to repeat itself because human nature repeats itself. And that's why it's so important to look at longer-term price charts to see what, say, the gold market has done the past several months or several years and get a gauge for how human nature has reacted and how prices have reacted in a repeatable fashion over the years. And that certainly is the case. Indeed, human nature repeats itself. And to give you an example of how important psychology is in the marketplace, I always ask this question to my students or my listeners in my webinars. When is a market the most very bullish? When is that market so bullish that you just think prices are going to go to the moon? Well, a market is the most very bullish when you see on that last price bar the market that hits the high. When the market hits its highest price before it starts a downturn, that's when the market is the most very bullish. And that's why trading and investing can be a very difficult endeavor, especially on a shorter-term basis. Traders tend to get all bulled up. The market makes a big rush higher. It sucks in Public interest sucks in general people that maybe not even following a market. They read about a bullish market in the newspaper. They want to get on board. Well, those are the signs that a climactic type price move is occurring in the market, probably near a top. And that's a good example of trading psychology in the marketplace. And this goes for the shorter-term futures traders, which I know we do have a lot of them. I know that we have some longer-term traders that this doesn't apply to, but most shorter-term traders are wrong most of the time just because of the choppy, volatile nature of the marketplace. Another factor regarding trading psychology is contrary opinion. And by that I mean those of us who have been in this industry a long time know there's an old saying that if you read about a market on the front page of the Wall Street Journal, that there's a good chance that market's put in a top. Because like I said before, the general investing public has caught wind of a market move, and they're the last ones to jump on board. And there's also another facet of this of trading psychology, and that's contrary opinion. And that is when if you get a majority of even analysts that are heavily weighted in being bullish a market or bearish a market, there's a good chance that market may be about ready to turn. So that's something to keep in common too. I've always been one that does not feel real comfortable being on the bandwagon with what other analysts or traders are doing. I like to use my own work and my own analysis, and you know, I'll land where I may. But history shows that if at one time too many analysts and too many traders get on one side of the boat, being too bullish or too bearish, then the market's probably ready for a turn. Okay, we're going to spend the last segment talking about my Wyckoff's market rating system that you see on the Kitco news section of the website, and you also see those in my analytical chart. And there's an interesting story behind this and how this rating system came to be. I've been doing analysis like this for many years, and several years ago I had a guy email me and say, you know, I'm new to this business. I don't know technicals very well. I want to learn more, but I just, you know, is there any way you could use your experience to gauge the strength of a market trend and put that on some kind of a scale of 1 to 10 and just have that every day? And I thought to myself, well, you know, that's awful simplistic. I'm not sure if you know, my readers would appreciate that. But then I thought to myself, you know, I look at literally hundreds and hundreds of charts every week, and when I look at a chart, I can immediately see a chart pattern. I can immediately see a trend, whereas, you know, people that have day jobs and people that don't have that kind of experience, people that don't do that for a living, they don't have that kind of experience and knowledge to just recognize that. So I decided, you know, I'm going to implement this market rating system on a scale of 1 to 10, with 1 being a very, very strong price downtrend, and 10 being a very, very solid price uptrend, and go with it. And it's been a very popular addition to my body of work. So we'll start out by looking at some of these ratings. Here we have a Wyckoff's market rating of 10. You see that the market's in a strong price uptrend, and a market rating of 10 is a rare occurrence. We see a strong price uptrend here in this market. We've set a new high. Market rating of 10. Now that's a very powerful market trend that is occurring, but we can also extrapolate that to think, well, this market is a very mature bull market, and much of the price move has already occurred. So the market rating of 10 is a very strong price move that's occurring, but it also is a very mature bull market that could be ripe for a downside correction. Conversely, a market rating of 1, this market's in a long-term solid price downtrend. It's just scored a new low, and it's got a Wyckoff's market rating of 1. A rating of 2 is a market that's just kind of bounced off its recent low. Still a pretty weak market, still in a downtrend, but has made a slight bounce off its low. Okay, a market rating of 5, and that's close to what the gold market right now is in a 4 to 5 range. But a market rating of 5 is where the bulls and bears are doing real battle, and really neither one of them is gaining much momentum as the market chops back and forth. So if you see a Wyckoff's market rating of 5, you can bet that the near-term trend is fairly choppy and indecisive as the bulls and the bears struggle. And now is a good time for me to also explain, when you read some of my work, I talk about near-term technicals and I talk about longer-term technicals. The near-term technicals I talk about are the technicals that you can see on a daily chart or an hourly chart, but most likely a daily chart is what you'd be looking at. So when I talk about near-term chart damage being inflicted in the gold market this week, it's when you look at a daily chart, you can see that, you know, a price uptrend has been negated. We're starting to trend prices lower on a near-term basis. Now, this compares to what I call my longer-term technical analysis, or the long-term technical posture of a market. You can look at the long-term technical posture of a market by looking at a weekly or a monthly chart. And if you look at a weekly or a monthly chart in gold right now, the price trend is still up. So on a longer-term monthly chart right now, my market rating on gold is probably an 8, based upon the fact that gold prices are in an 11-year-old uptrend. But on the daily chart, the price, the Wyckoff's market rating today, I think, was a 4 because the market, you know, has taken a beating this week, even though no longer-term technical damage has been inflicted. Here's a market rating of 9, a pretty strong price uptrend in place, and also you'll see I have some moving averages on here. We'll talk about moving averages in a future webinar and go over some of what I call my secondary trading tools. Here's a market rating of 6.5. The market's just started to, it's moved up off its low and is starting to trend higher. That's a pretty good rating. Now the markets that are rated in anywhere from the 5.5 to 6.5 or a 7, those are good. Those are markets that are just starting to trend or just produced a bullish breakout. Those are the markets that are probably good buying opportunities. Here's a market rating of 6. Market rating of 8. I might even rate that market a 9. We've seen a bullish upside breakout here in that market. Here's a market rating of 3. The market has made a low and is just starting to move higher. Market rating of 4. The market has been trending lower for a while. The markets that are rated in the 4.5 to 4 to 3.5, those are good markets to think about. You know, they're probably a decent selling opportunity. Here's another market rating of 5.5. We've pushed prices higher, but then we're just kind of starting to chop around a little bit here. Market rating of 7. Okay, we've got a few minutes left for some questions and answers, and many of you did submit prior to the webinar some questions, and most of them involve what's the price of gold going to do here in the near term? What has it done? What's happening? So I have the luxury of having real-time prices in front of me right now, and as we speak today, gold's trading. April gold is trading at about 1648. We have done some significant technical damage this week. We pushed prices to a 2-month low. So the market, on a near-term basis, the bears have some technical momentum. We've got some strong technical support at yesterday's low in April gold of 1634.70. If we push prices below that price level, that's going to give the bears some further downside technical momentum and possibly induce a challenge of psychological support at the $1,600 level. On the upside, we've got some solid technical resistance in April gold at yesterday's high of 1682.80. You really got to produce a close above 1,700 and then push prices above this week's high of 17.40. That's April COMEX gold to give the bulls some fresh upside technical momentum to suggest that we might have put in a low. But again, importantly, if you ask me what is my most important technical time frame, the near term or the long term posture of a market, it's the longer term. The longer term technical posture of the gold market remains bullish. Prices are in an year-old uptrend. If you look at past price history on the monthly chart in gold, you're going to see that we have these downside price corrections that are significant, but yet the market continues to trend higher. So from a longer-term technical basis, the path of least resistance for the gold market is going to continue to be sideways to higher on that monthly chart until the last reaction low is penetrated on the downside. And I don't have a monthly chart in front of me, but I think you'd have to push gold below $1,500 to start to produce some significant longer-term chart damage to then call into question that price uptrend. And with that said, I'm going to give it back to you guys, and I hope you have a great day, and I hope you tune in next time. Bye-bye.